we want to keep talking about this and how it impacts everybody who's interested in making some investments. We invite back into the stream Ryan Detrick, LPL Financial's Chief Market Strategist. It's always good to have you here. The Fed speaks one language. Let's try and do this in English. In English, for those of us who are very just average retail investors, what do you take from those minutes?
Yeah, right here, we don't think it's too much of a curveball, right? Like you guys just mentioned there's some Feds that are doves, some that are hawks, meaning, maybe we should be a little bit more worried about inflation than we're not. The one thing that matters when you talk about the Fed is the guy driving the bus, Jerome Powell's opinion. Everybody's got an opinion, right? He's made it very clear what he's been saying. The Fed is going to continue to purchase assets. They're going to continue to keep rates low. Yes, we likely are going to see a hint of tapering, probably maybe next week, but definitely by September at the September meeting. And that just means maybe instead of buying $120 billion worth of bonds every month, maybe we're buying $105 billion worth of bonds every single month. So the truth of the matter is Jerome Powell is what matters. And he's still saying until jobs really come back, which, we've been having, almost 1 million jobs created the last couple months. We've still got a ways to go, and the Fed is still a tailwind. And that, in our opinion, is why stocks are virtually flat on the day, but again, chip shop all-time highs as we speak.
Ryan, this is Emily. As we head into September, of course, Fed policy uncertainty is one factor, but another factor that you point out for markets is the fact that September does tend to be seasonally more weak for the markets. What should investors really be looking for as we head into the next couple weeks and months of trading?
Yeah, Emily, that's right. I mean, you think about it, we just had the fastest 100% rally off of the lows, at least since World War II, all right, in stock market history. We just hit it the other day on the S&P 500. That's about 17 months to get to a double. It took just about 25 months or so, the previous fastest off the last bull market. So what I'm getting at is, as investors, we've been pretty spoiled, right? It's been a great ride on the way up. Just be aware that rubber band is stretched awfully far, and then you consider the fact that September is right here. And you're going to hear a lot about the next 2 weeks. Historically, September is the worst month of the year on average. A lot of volatility in September. And do not forget, last year in September, guys, we saw almost a 10% correction. Not quite, but almost. Anybody remember why? I do this for a living. I can't remember why, but it happened, okay? The calendar is something we need to be aware of after this huge rally. Maybe we blame it on the Fed. Maybe we blame it on the economy, inflation, whatever the reason is. The calendar could be a reason that a normal pullback after a 100% rally would make sense to us, and maybe September could bring it.
All right, so a lot of people are asking very simply, how do I make money? And one of the things you're talking about is you like small caps over large caps. Why is that, especially if, and this is not the best way to look at it, but Russell 2000 is up 10%, the S&P 500 is up 18%. Right. Learn me something here.
No, you're right. And you think about what happened in the fourth quarter, right? Small caps were up like 25%, one of their greatest quarters ever. You look at things, small caps have kind of been consolidating, honestly, most of this year, whereas obviously large caps have gone higher. So if you're looking for an area to maybe start to outperform a little bit after a little underperformance, we think it could be small caps. And the other thing, let's not forget, this is an early bull market. This is an early economic cycle of growth. We've looked back in history, and the first couple years of new economic cycle of growth, you want to be in the more aggressive areas, the cyclical, your small caps. We think those areas, which have kind of been left for dead, honestly, the last couple of months, we don't think they're dead yet. And we think as the second half of this year, as the economy continues to expand and the economic cycle grows, your small caps and your cyclical value are two areas that'll probably continue to do really well here in our view.
We're on the tail end of second quarter earnings season, of course. We have that expected S&P 500 growth rate tracking at about 89%. As we head into the back half of this year, is that potential for that earnings growth deceleration adequately priced into the market right now?
Yeah, I mean, earnings have been amazing, right? I mean, this time about a month ago, we said second quarter earnings up 65%. Now we're pushing 90. We've seen 2 quarters in a row now where earnings estimates have come in close to 20% higher than expected. So our view is this: earnings are helped justify why stocks are at all-time highs. Guys, for the year, the S&P is up about 18, 19%. earnings estimates are up like low 20%. So if you thought stocks were expensive to start of the year, stocks are actually cheaper now because earnings estimates are up more. So yes, the bar is high. Yes, we all know earnings are coming back. The economy is coming back online. But do not, the U.S. consumer continues to impress more than anyone could believe. And we think you wouldn't want to bet against them quite yet. And we think earnings will continue to improve, help justify, again, maybe we get a 4 to 8% correction after 100% rally. But the economy with the fiscal stimulus, monetary stimulus being led by earnings, which really matter, and I'm not talking about revenue, one of its best quarters ever in the second quarter, those things are reasons to think this bull market is alive and well.
Ryan Detrick, LPL Financial Chief Market Strategist, always good to see you. Look forward to your return.